2 hours before Donald Trump's deadline to destroy Iran's whole civilization, he announced a ceasefire, and the market had already priced in the bluff. That tells you something important. The S&P 500 and Nasdaq finished Tuesday in positive territory, even as Trump threatened total war. Traders, now veterans of what markets called the taco trade, Trump always chickens out, had stopped flinching. They were already positioned for the reversal. When the deal landed, the math was immediate. Brent crude fell 16%. U.S. oil dropped 19%, breaking below $95 a barrel. The Dow surged 1,300 points. The Nasdaq climbed 3.4%. Global markets followed. Germany's DAX up 5%, Japan's Nikkei up 5.4%. The mechanism was straightforward. Iran's control of the Strait of Hormuz had been the single choke point holding global oil supply hostage for 6 weeks. A fifth of the world's oil and a third of its urea fertilizer exports passed through that channel. When Trump's deal included a condition to reopen the strait, the oil risk premium evaporated almost immediately. J.P. Morgan's trading desk flipped tactically bullish within hours. Their analysts wrote that stocks could breach 7,000 on the S&P 500, a 6% jump from Tuesday's close, and that Magnificent Seven and semiconductor stocks were poised to explode higher. The phrase they used, euphoria returns to markets.
But the strait is not fully open. By midday Wednesday, Iran had reportedly halted tanker transits again after Israeli strikes on Lebanon. Vice President J.D. Vance called the agreement a fragile truce. The ceasefire is 2 weeks long. Brent crude, even after Wednesday's crash, is still 50% above its pre-war level. The oil risk premium has not been eliminated, it has been discounted. The ceasefire handed the Federal Reserve something it desperately needed, a plausible exit from the worst energy shock in years. The market responded by doubling the odds of a rate cut by year-end, from 14% before the announcement to over 43% within hours, per CME FedWatch data. That repricing matters because the Fed had been quietly moving in the opposite direction. Minutes from the March 17th-18th meeting, released Wednesday, showed officials were weighing both cuts and hikes simultaneously, an almost unprecedented dual-sided posture. Most members still expected one cut this year, but Fed Cleveland President Beth Hammack said publicly that she sees rates staying on hold for quite some time, and added that a hike was possible if inflation remains stubbornly above 2%. The math behind that caution is stark. Before the ceasefire, Cleveland Fed estimates put March inflation at 3.25% year-over-year. Gas prices had risen 41% from pre-war levels, with national averages at $4.12 per gallon. Jet fuel costs for airlines like Delta jumped 88% since late February. The war had embedded itself into nearly every price in the economy, from urea fertilizer up 35% in March to manufacturing transportation costs. Now comes the test. On Friday, the Bureau of Labor Statistics releases the March CPI report, the first inflation print that will capture the full war effect on consumer prices. Economists expect a headline reading of 3.3%. If that number surprises to the upside, the Fed's credibility as an inflation fighter gets tested again. If it surprises low, or if oil prices hold their Wednesday losses, Citi's forecast of 3 cuts starting in September suddenly becomes a real conversation.
The Fed's bind is structural. Cutting rates into an energy shock risks entrenching inflation expectations. Hiking into a slowing labor market, GDP grew at just 0.7% in Q4 2025, risks tipping a fragile economy. Chair Powell acknowledged both risks. The minutes confirmed the FOMC voted 11-1 to hold in March. That consensus may not survive Friday's CPI. The Meta story Wednesday was not just Iran. Meta platforms surged 8% after releasing Muse Spark, the first AI model from its Superintelligence Labs division, built by Alexander Wang after Meta invested $14 billion into Scale AI. The model deploys multiple agents simultaneously, includes enhanced health response capabilities developed with 1,000 physicians, and a shopping feature that turns creator content into product recommendations across Facebook, Instagram, and WhatsApp. The timing was not accidental. Wedbush analyst Dan Ives had already argued that the Iran conflict created an oversold tech environment and that a ceasefire would function as an unlock for the entire Magnificent Seven. Meta, down 6% year-to-date before Wednesday, and Alphabet, barely positive, both had valuation compression built in from weeks of geopolitical risk premium. When that premium partially unwound, the re-rating was fast. The question now is what sustains it. 3 conditions determine the next 2 weeks. First, whether the Strait of Hormuz actually reopens to full traffic, not just a few tankers at Iran's discretion, but normalized commercial shipping. Second, whether Friday's CPI comes in at or below the 3.3% consensus, giving the Fed cover to stay on the sidelines rather than pivot hawkish. Third, whether first quarter earnings, kicking off with Delta already beating estimates, validate the expectation of 13% year-over-year earnings growth that JP Morgan's desk is banking on. The weight of evidence leans toward the rally having room to continue, but the base is fragile. The ceasefire is a pause, not a resolution. Iran retains physical control of Hormuz. If shipping resumes and CPI prints benign, the S&P 500 testing 7,000 is plausible within weeks. If the Strait stalls again and Friday's inflation number surprises high, the relief rally reverses, and the Fed finds itself back in stagflation territory with fewer tools than before. The verification benchmark is Friday at 8:30 a.m. Eastern. The March CPI number will either confirm the ceasefire optimism or challenge it. Watch the 10-year Treasury yield the moment the number drops. If it rises sharply, the market's rate cut repricing unwinds. If it falls further from Wednesday's 4.24%, the rally has fuel.